He's really getting mad when he notices that every single bottle of distilled spirits, you have to send the Fed $2.14. He also picks up a few packs of cigarettes, 39 cents each. Congress tried to raise this by 156% last year, and he also grabs a few cigars, a nickel. Congress tried to raise that by 20,000% last year to $10 a cigar. Taxpayer Joe shakes his head. He doesn't understand why the government is trying to tax him when he hangs out with friends, has a good time, but they sure seem to be doing a good job of it. So now I've got 3 questions for you folks. I just rattled off a bunch of federal excise taxes. Raise your hand if you knew every single one of those taxes existed. Nobody? Have I convinced you that the federal government likes to nickel and dime us? Yes? I hope so. I hope so. And have I convinced you that we need to think about more than just federal income taxes when we talk about tax reform? I hope so, because they're there and they're taking our money and we're not even noticing it. So tonight we've heard a lot of big ideas, the fair tax, the flat tax, but these focus mainly on income taxes. Do not forget that federal excise taxes are out there. So here are some principles to keep in mind when we're talking about tax reform if we want to target these excise taxes. 1, transparency is key. It should be clear and obvious what we're being charged. There should be a line item on our receipt saying what we pay in federal gas taxes every time we fill up. The federal government is making a profit off of our fill-up time, and that's just not appropriate, and at the very least we should know about it. The government really shouldn't be picking winners and losers. Why is sport fishing taxed by the federal government and horseback riding isn't? Why is archery hit, but another sport like soccer isn't? The government shouldn't be deciding what is good and good not behavior with excise taxes when there really is no difference between it. The final thing is to say simple. Why should a bottle of wine be taxed differently than a bottle of champagne? Companies spend valuable time figuring out what taxes they have to levy on their products, and I would rather see them use this time developing a better product. So whichever tax reform plan we pursue, we need to remember excise taxes. Income taxes are a big deal. We pay thousands of dollars, but Uncle Sam is hitting us with excise taxes as well. Thanks so much.
Can people get a copy of that? Yes.
Sure.
Okay, because I think many people would be interested in having a copy of that. Certainly what Christina brought to the table is important. It is just an example. I mean, if you're at the local level, you're looking at the kind of impact fees and runoff fees and rainwater taxes and viewshed taxes if you're in the mountains. That means if you're on the side of a hill and your house looks nice, then you may have to pay a viewshed tax in addition to your property taxes. These are the kind of things they are looking at all over the state of North Carolina. Our next speaker, Jonathan Martin, graduated from North Carolina State University with a degree in accounting and financial analysis. Following college, Jonathan worked in several accounting positions at various private sector businesses over the last several years before being accepted into the Charles Koch Associate Management Program based in Washington. Currently, Jonathan is working at AFP, Americans for Prosperity's office in Washington as a policy analyst and will continue to do so throughout the remainder of the Koch Management Program. I'd like to welcome you, Jonathan, and remind you to please write your questions down. We will be collecting those, and when we come back, we'll be talking about that. So this time, Jonathan Martin.
Thank you all very much. I know we've been up here talking for almost an hour, so I'll try not to lose you in the next 8 minutes, all right? Given the 10-minute allotment, I want to just stick to a couple key things I think is very important for us all to keep in mind under a supposed President Obama. Now, aside from the fact that it gives me a few chills to say that out loud, I think it's very important that when you're all sitting in these coffee shops that we've talked about and you're all having debates with your family and friends, that you can actually say, you know, well, this is what I know is going to happen under Obama's Social Security tax. This is what's going to happen with a corporate windfall profit tax, and so on and so forth. So first I want to talk about the Social Security plan. As it stands, and I say that because, as many of you know, Obama's policies change pretty much with the wind. So what I want to talk about is currently, at least at the end of June, this is where he stood. Obama plans to apply the tax itself to those making over $250,000, in addition to the taxes that those same people already make when they reach the $102,000 mark. This is really important because in reality, Obama has crafted this well. As Lawrence Lindsay at the Wall Street Journal pointed out, that $102,000 to $250,000 bracket is a huge demographic he doesn't want to tick off. Quite frankly, if he were to tell this group of individuals that they're going to catch a 12.5% tax hike, they're probably going to be a little upset. Instead, these top income earners will face the taxes all in the name of desperately needed revenue to close the deficit gap that right now is approximated at $24.5 trillion between benefits paid in tax, between the benefits received and tax revenue received. The problem is that only 3% of the population make over $250,000. And I need to say that again, only 3% of the population makes over $250,000 a year. That's really important because he wants to sock these individuals with a tax to redistribute among the rest of the country as he, Pelosi, and the rest of Congress see fit. And as it stands, we have a Democratic nominee that's pushing for a private sector to become $5 poorer so that the government can become $1 richer. That's pretty scary. The math doesn't make any sense, and what we're talking about here is a president that would drive tax rates to levels unrivaled since Jimmy Carter and Richard Nixon. This past week, according to an AP article, even the rich are starting to feel the squeeze. What troubles me is the fact that when people seem so often to forget, including Obama, is that when you take away income and incentives to work harder, that effect trickles down. These are a couple of key points to remember. The 10% of households with the highest income in this country account for nearly a quarter of all spending in the U.S. That's according to Moody's Economy.com. 70% of the GDP comes from consumer spending. And one group, the affluent, and their spending habits create economic activity. And the bottom line is that economic activity creates jobs. That's it. I mean, it's indisputable. This past Friday, the Labor Department reported that the highest unemployment rate in 4 years had come out due to the current credit crunch and financial woes of the country. Imagine if we threw higher taxes in there. There's only so much you can tax, and that goes for the rich as well. Eventually, Obama will have to realize that taxing the top 1 to 3% of income earners is going to run out. Curbing spending is what's going to bring that down, not close revenue gaps. Certainly, the GOP is equally to blame. But however, as it stands, Obama will ultimately bring tax rates to French and German levels. Now, for those of us not making anywhere near $250,000 a year, like myself, it's important to remember that disposable income per capita is lower in countries that has burdensome tax policies like the average 15 European Union countries. There's two main issues that that you all need to take away from the Social Security plan. All right, I understand it's incredibly intricate. When I first tried to wrap my head around it, I had to read it about 10 times. I mean, I don't even think I've actually seen Obama asked in a town hall style meeting how to explain it in about 30 seconds, and he couldn't do it. So the first thing I want you to remember is that people will be working and not receiving benefits that they paid in. It basically violates President Roosevelt's initial plan for implementing Social Security. The second thing to remember is that the tax hike of 12.5% of top rates reduces incentives for people to work, okay? When you increase incentives to hide money from the IRS, and those of you that might think about going into forensic accounting under President Obama, you'd have a great career. The argument that this is what we have to do to fix what GOP policies have failed is nonsense. Basically, Obama's plan barely touches a third of the deficit. I mean, that's a bottom line. That's assuming that people don't stop working as hard as they can to avoid paying taxes. Think if a president were to come into office and tell you that if you work a little harder, I'm going to take a little bit more of your money. I know I'm not going to work that next step to just give them a bigger check every year. So now I want to talk about capital gains. As Brandon mentioned at the very beginning, capital gains are very important. They implement quite a backbone of what the economy bases around as far as investments. When interviewed on CNBC in March, Obama said the following. This is what he said. This is a scripted response to capital gains. Well, I haven't given a firm number. Here's my belief, that we can't go back to some of the, confiscatory rates that existed in the past that distorted sound economics. And I certainly would not go above what existed under Bill Clinton, which was 28%. I would, and my guess would be, it would be significantly lower than that. Obama himself even has said that it's okay to essentially double the capital gains tax, because in his mind, he's keeping things fair. And knows full well that less revenue will come into the Treasury. He's actually said that. He said, if I double the capital gains tax, I realize less revenue will come into the Treasury.